Brokers publicly disclose that up to 80% of retail CFD traders lose money and blow up their accounts. Yet in March 2020, the most sophisticated financial institutions on Earth, primary dealers, experienced a systemic failure that looked remarkably similar. The United States Treasury market is designed to be the deepest, most liquid financial environment in existence. But over a few days during the onset of the pandemic, trading violently halted. Sellers panicked, and the buyers completely vanished. The standard industry narrative separates these two outcomes. We attribute retail trading losses to a lack of psychological discipline, while we blame the prime dealer freeze on complex post-2008 banking regulations. Exchange filings and supervisory reports reveal that the retail wipeout and the global sovereign debt freeze are twin symptoms of a single process, the collision of market volatility with rigid structural risk limits. Long-term market survival depends entirely on the mathematical capacity to withstand forced constraints when the market environment shifts. In the aftermath of March 2020, economists pointed to a specific banking regulation as the cause of the crisis: the supplementary leverage ratio, or SLR. The SLR is a non-risk-weighted capital requirement. It calculates a bank's required capital by taking a quarterly average of its total leverage exposure, treating safe treasury bonds exactly the same as high-yield corporate debt. Because the SLR relies on a trailing quarterly average, it is slow-moving by design. The calculation is structurally blind to sudden intraday spikes in market volatility. When the pandemic panic began, prime dealers actually possessed substantial headroom under their SLR requirements. A temporary surge in treasury inventory would not have immediately breached their quarterly regulatory threshold. Since a lagging quarterly metric could not mathematically react to a sudden intra-week volatility spike, a much faster internal risk mechanism had to be responsible for choking off dealer liquidity. To locate that mechanism, we first have to look at the mathematical baseline required for survival at the micro level: expectancy. This diagram shows the formula for trading expectancy. You calculate it by multiplying your win rate by your average winning trade and subtracting your loss rate multiplied by your average losing trade. If this number falls below zero, a high-frequency strategy bleeds capital regardless of its predicted direction. Proprietary trading firms engineer positive expectancy by imposing strict external parameters on their traders, such as daily loss limits and trailing maximum drawdowns, cutting off access to capital the moment a threshold is hit. To avoid hitting these drawdowns, position sizing must dynamically scale inversely to market volatility, often measured by the average true range. As the daily price range widens, the size of the trade must shrink. Deploying a fixed stop-loss guarantees a limit breach. The structural mechanics of risk management will always override the theoretical edge of the strategy. This same principle governs the largest institutions, but instead of static drawdowns, prime dealer trading desks operate under dynamic, highly sensitive internal constraints. The universal counter-cyclical risk limit mandated across major treasury market-making desks is known as value at risk. Value at risk measures the maximum potential tail risk a specific portfolio could suffer over a set time horizon, usually one day, at a given confidence interval. Because VAR calculations incorporate current market conditions, a desk's risk footprint can aggressively expand while holding the exact same assets, simply because market volatility spikes. The asset doesn't change, but the mathematical risk it represents inflates. This creates a rigid, inescapable ceiling. During market panics, that ceiling effectively shrinks, structurally overriding a trader's intent to buy new assets, no matter how cheap they get. We can prove the power of this constraint by comparing a highly risk-averse human trader to a strictly risk-neutral algorithmic model. Equation 1 shows a risk-averse human maximizing wealth while minimizing volatility. Equation 2 represents a risk-neutral agent optimizing wealth beneath a strict value-at-risk ceiling. Applying a Lagrangian transformation merges the objective with the constraint. The resulting Lagrange multiplier shadow cost is mathematically identical to the human risk aversion coefficient. This proves that the exact moment a value-at-risk limit binds, a strictly risk-neutral entity is forced by its own mathematics to behave identically to a terrified risk-averse human. We can see this mathematical duality executed in the real world by applying it to supervisory Volcker rule data during the collapse of the U.S. Treasury market. This chart demonstrates how the extreme pandemic volatility expanded the risk profiles of existing portfolios. Prime dealers were instantly pushed to 100% of their internal VaR limits, maximizing the shadow cost of risk. The supervisory data quantifies the resulting behavioral shift. Once their limits were saturated, constrained dealers demanded 9 percentage points higher profit and loss per unit of VaR just to take on new client positions. Because VaR scales with both volatility and time, long-duration treasury bonds carry the highest value-at-risk footprint. For a desk desperately trying to lower its limit utilization, these bonds become incredibly toxic assets to hold. Prime dealers actively dump the most risk-free bonds on Earth onto the open market. They didn't do this out of economic panic. They did it because mathematical optimization dictated an immediate, forced reduction of VaR. The intervention that finally stabilized the Treasury market was the Federal Reserve's massive System Open Market Account, or SOMA, purchase operations. The central bank stepped in to directly absorb long-duration Treasury inventory, stripping those specific assets off the prime dealers' balance sheets. Mechanically, this flowchart shows how the process worked. By removing the bonds carrying the highest risk footprint, the Fed artificially lowered the dealer's total portfolio VaR, instantly clearing vital headroom under their internal risk ceilings. By removing high-duration debt, the Federal Reserve mechanically absorbed dealer value at risk, dropping the shadow cost of risk and restoring the system's capacity to intermediate. This creates a unified framework connecting a localized algorithmic trading blowout to the freezing of global sovereign debt. Market stability at any scale relies entirely on managing the rigid mathematical boundaries of structural risk. When external volatility expands, those boundaries dictate the action. The micromechanics of retail ruin, where an account breaches a fixed drawdown and is forced to liquidate, map exactly onto the macromechanics of an institutional liquidity crisis driven by VaR limits. The entire market operates as a single mechanical system, governed by identical structural rules, whether the participant is trading thousands of dollars or trillions. Market failure is the inescapable, highly predictable output of mathematical optimization forced against absolute structural limits.